Look around you, different things born out of truth and passion. Business software, it's our craft, our identity. Thoughtfully engineered, passionately designed to help you transform your business. Zoho, made in India, made for the world.
Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita and with me is Ayesha Faridi. And we'll of course have guests come in and give us a perspective on how markets are doing. But let's quickly look at what the Nifty is doing. 0.25% higher. That initial bit of zing that we saw didn't sustain. Some bit of weakness crept in and now we're seeing some bit of a bounce back in markets. We're currently holding 24,722. It's a fairly range-bound market in that sense. Around 200 points is what the market is playing at least at this point. Now, within some of the Nifty gainers and some of the top ones, let's pull up an IndusInd Bank, 2.3% higher. Eternal also up 2 odd percent. You had a Wipro also, which is up 2% odd. Hindalco is also doing fairly well for itself. So those are some names doing well. Axis Bank, on the other hand, down 2%. And I'll be curious to know what's happening with the Nifty Private Banking Index. Let's pull that one up. And that'll also give us a perspective on what's happening within the private banking space. But I wouldn't reckon that it would be too good. There you go. Absolutely flat where the Nifty Private Bank is concerned. And that's because of that choppiness that we're seeing in terms of performance across banks. Let's look at the Nifty Mid Cap now. 0.5% higher on the Nifty Mid Cap. The Nifty Small Cap also up 0.2 odd percent. So that texture looking okay, but well off the highs. Both of those indices are off the highs of the day. Of course, we've seen a bit of a bounce back on the small cap index from the lows as well. But the mid cap, can we pull that one up again? And I'll be curious to know what and how that index has. There you go. So it absolutely was at the flat line at the low point of the day. And thereafter, we've seen a bit of a bounce back where the mid cap index is concerned. 0.6 odd percent higher. Now, I want to quickly also talk about some sectors before I toss it across and get a perspective on the charts. 1.3% higher on the Nifty Realty. So in broader markets, that's where some amount of zing seems to be creeping in. Oil and gas index also doing well for itself, 1.4% higher. And we're seeing among the larger cap names in sectoral indices, 1% higher on the Nifty Metal. It's cooled off from the highs of the day. The Nifty Auto doing fairly well for itself, around 0.7% higher. But it's essentially a show by the Nifty PSU Banking Index. That one is up 1.7% in trade today. And that's where a large part of the outperformance seems to sit, where sectoral indices are concerned. So that's the play at this point. Kunal Bothra also joining me on the show. And we also have Aditya Agarwala joining us. So welcome both of you. Good afternoon. Kunal, let me start with you first off. Give us a perspective with regard to where the Nifty Bank is at this point versus where you're expecting it to be. And what do you make of the move today?
Good afternoon. No, I think it's a very good move for the markets today. And I'm not saying not in just in terms of the 60-point, 70-point bounce back, but the mannerism in which the markets have behaved today. So we opened with a gap up for the indices, or at least some bit of positivity for the index. The first half an hour, first 1 hour, we saw the index just about trying to show signs of strength, coming back again. Large cap stocks were, some of them were at least starting to show signs of recovery. But then came the mid, or the initial bout of selling where the indices managed to make a new low, even managed to break below the previous, I think Friday's low for both the indices Nifty as well as for the Bank Nifty. And now the second recovery. So in effect, what we've done is just we've formed a W pattern for the indices, double testing a major support and then trying to reestablish the point that testing that strong support territory for the Nifty as well as for the Bank Nifty, we've managed to see a bounce back. This is extremely positive, I would say, for the markets, at least over the near term. And this also indicates that we should now be looking at the path of recovery extending slightly bit more forward for many of the individual stocks and sectors.
Aditya, hi, afternoon. That's the point, right? That whatever said and done, while we've not managed to stay put at the high point of the day, but the green at least has stayed for the larger part today. And more importantly, like Kunal was flagging off, it's a better attempt and a more successful one at that from the mid and the small caps today. What's that telling you about how to trade this market going forward?
Afternoon, Aisha. Thanks for having me on the show. Clearly, if you take a look at the way markets opened and then we saw a complete sell-off on all fronts, be the mid-cap, small-cap or the large-cap, the benchmark indices. And then just around the second half of the trading session, markets are showing some signs of recovery. And it's a smart recovery, I would say, Aisha. I wouldn't rule out the fact that we might scale past the high of intraday today as well on the Nifty. And if I take a look at the small cap and the mid cap indices, there too I see a bit of a bump up still due in the indices, because clearly we've seen massive sell-off on Friday in the mid cap and the small cap space. So there you could see another round of up move both on the mid cap and the small cap. But for me, what stands out is the way that the Nifty has turned around and showing strength at the moment. And I would rather be of the belief that markets will scale past intraday high, which is somewhere around 24,800, and should head to levels of 24,900, 25,000 this week sometime. Overall, it's been a good move that we're witnessing on the bank Nifty as well. So it's a matter of time before I think your large cap private sector banks, which Harsh was also alluding to some time back, might just see a recovery and a short covering rally as well, because we've already seen PSU banks outperform. So it's time for large cap private sector banks to take leadership, especially names like Kotak, HDFC and Axis, which was witnessing a good move till last week. So my sense is 55,000 to about 55,400 on the bank Nifty is also something that could be possible in a couple of weeks from here on.
Right, okay. So let's break it down into what it implies for stock trades as well. Kunal, what's on your list?
So I'll go with two buy calls, and the first one is one Indian bank. I think the stock has done exceptionally well. Less talked about, but then more of a silent performer over the last many weeks and months, trading at 700 plus mark. So would look out for 745 as an immediate target. Stop loss could be kept at 710. And the second would be a buy from the OMC. I think there's a decisive breakout for many of these oil marketing companies. BPCL is what I would pick at current levels. Near-term target of 345. Stop loss at 330.
Okay. Aditya, let me come to you for your picks.
A similar kind of a flavor, Harsh. A bank and an OMC I have picked up as well. From the PSU lot, Bank of Baroda is something which is looking quite interesting to me on the charts. We have seen constant up moves, higher highs, higher lows. My belief is that it will continue to head higher from these levels. For a target of 265, I'll be a buyer here with a stop loss at 247 on the downside in Bank of Baroda. From the OMC space, I've got an IOC. That is also looking quite interesting. So at current levels, I'll be a buyer in the stock for a target of 160 on the downside, with a stop loss at 142 on the downside, with a target on 160 on the upside. So IOC and Bank of Baroda, these are two buy calls from my side.
Okay, so those are the buy calls coming in from Aditya Agarwala, but let's talk about some stocks which are moving in trade. And I did speak about OMCs. The oil and gas index itself is showing some amount of zinc, so that's the one key positive. Those are some stocks, and look at the moves over here. You have a 4% on a BPCL, IOCL up 3, HPCL up 4.5+%. So strong moves seen there, and we'll just quickly take a tech check on this as well. But some stocks hitting their 52-week highs. There's a Tata investment on the back of, obviously, Tata Capital's IPO. This one has shown remarkable resilience, 3% higher even in trade today, on top of all that it has done. Now nearly touching 9,000, that stock. And then there's RBL Bank. So that one also doing fairly well for itself, 2% high. And then there's Vascon Engineers, where there's been a 5-year MOU signed with the Adani Group, and that one is up and away in trade, 18%. So very, very strong moves. In fact, what they've said also is that 30% of their top line will come from orders being placed by the Adani Group. So that will be fairly large, because currently it's 0. Plus there'll be some growth on that top line. On top of it, what they're saying is 30% will come from the Adani Group. So that's a fairly solid commentary. But Kunal, let me come to you with regard to some of these OMCs. What do you make of the move? BPCL, IOCL, HPCL, what's the sense?
This is a very good move, Harsh, for many of these OMC stocks. And, it's not just today's breakout which is exciting about the prices. I think you look at the built-up of the prices over the last couple of weeks. There was a very slow, gradual, short covering, zone for many of these oil marketing companies. It started off with IOC starting to show signs of recovery. from that 130, 35 key support points. And then I think it's trickled back towards the other two larger cap names, BPCL as well as HPCL. I think all three of them showing signs of a synchronized breakout. The built up over the last couple of weeks, I think that's the more interesting aspect about the charts for these OMC stocks. So we are not looking at a minor kind of an uptick over here, but I think we should be looking at a decisive change of trend for many of these oil marketing companies. So it becomes a buy at current levels, even from a trading play as well as from a positional to investment kind of a time horizon.
Oh yeah, OMCs clearly seem to be the flavor today. But let's address a piece of exclusive info that we're picking up. And with medical inflation on the rise and no standardization in the hospital industry, insurers are now batting for a health regulator so that we adopt global practices in pricing as well as treatment protocols, which would also benefit consumers. Anurag Shah, my colleague, is here with the details of the letter that was submitted by the industry to the DFS. Anurag?
So, tussle between insurers and hospitals going on. We have seen in last 2 months that Hospital Association is suspending cashless treatment for few insurance companies. On the other side, insurance companies are also not empaneling a few big hospitals. So in this issue now, insurance industry has submitted data to Finance Ministry, Department of Financial Services, pushing for health regulator in the country. So as per the data submitted by insurance industry, there is an urgent need of health regulator in the country. So data also says that medical inflation in the country is increasing double digit, and with this continuous increase, health insurance will be unviable for many policyholders going ahead. Other than that, the other point shared by the insurance industry in a data and a letter to DFS is that hospital charge different rates, creating unprecedented claim outgo, and health regulator can standardize the tariff. Insurers also flag the frequent disputes between tariff and deduction raised by hospitals, disrupting the cashless services. So we have seen in last 2 months only that hospitals are suspending the cashless treatment for various insurance companies. So that issue also been raised. Insurers believed that standard rules would cut disputes and litigation between hospitals, and customers will get the clarity, policyholders will get the clarity. And on the global practice front also, most of the countries, many nations have a health regulator on pricing and treatment protocols. But in India, still it's awaiting only. So these are the main points and data shared by insurance industry to the government, to the Department of Financial Services. So in coming days, this data shared by insurance industry will be taken up with the health ministry also to have a talks with various stakeholders. One another important point mentioned by insurers is that in last few years we have seen that PE investor, the private equity investors, is pushing hospitals to chase for higher revenue and profits, and raising the healthcare cost, both insured and uninsured patients. So these are the main points shared by insurance industry to Government of India, Finance Ministry, to push their demand for health regulator in the country.
Thank you so much for getting us that, Anurag. You know what we're going to do? We're going to slip into a very short break. On the other side, we will have Nitin Bhasin, who is the head of institutional equities at Ambit, joining us. Will be interesting chat. Great.
Back to closing trades right here on ET now, and what a interesting off-cam interaction happening with Nitin Bhasin. But let's take it on cam and let's help our viewers as well benefit from all the insight. Nitin, great to have you in ET now studios.
Thank you.
Such a seesaw of a market and such a, I don't know, tug of war. There are so many adjectives to describe the market right now, yet at an index level, nothing really is happening for the longest time.
Yes.
How do you make sense of the market right now?
Thanks for having me, guys, over here. You know, the good thing is that for the last, 6 months or so, the market's been oscillating between 24.5.
The index.
The index. The Nifty,
Yeah.
Nifty 50 is oscillating between 24.5 and 25,500 here and there. But I think what we are noticing for the last nearly 1 year, 12 months or so, is that there's a change in the market in terms of how the concentration of the markets are behaving, whether it's the earnings concentration or whether it's the stock price concentration. What we've been writing for last year or so is, unlike the US, when in India the bull markets take shape, the market becomes more fragmented. The small caps and the mid caps perform. But now we are not living in that times. We're living in the times where the concentration will rise, the mega caps, the companies with more than 3% of market share, or let's say free float market cap, or the large caps will actually play out. So we are 12 months into this cycle, folks, but I would say such sort of a cycle historically has lasted anything between 24 months to 30 months. I hope it is different this time, but to us it appears that it could actually very similar to be what has been the past 24 months or so of large cap outperforming a mid cap or a small cap.
So Kunal tracks the charts very carefully. Kunal, is there historical data to prove how many months we're already done, and when is it that we're going to break free from this range?
No, I think it makes sense because now you're seeing that this kind of a tilt and a skew has already happened. I think it's already been like 12 months so far, give or take.
Saturday was the Nifty all-time high 1 year anniversary.
Yeah, 26,277.
4% away from the all-time high.
Yes.
4-5%.
Yes, and we've been meandering into this 1,500 to 1,000 point range
Correct.
for last, I think, 12 months.
Correct.
So I think, yes, in that sense, maybe a major part of the divergence has been shaping up over the last 12 months.
So Nitin, the question is, how do you now gear up for that breakout from this range in your portfolios?
So I think this is a stock picker's market. You'll have to pick right quality or right kind of stocks. Historically, what we've seen is that whenever such a cycle of concentration plays out, at that point in time, the concentration, three sectors, which is either pharma, IT, or to some extent even FMCG, they play out. So I would suggest that if the portfolio managers are building a portfolio of large cap names, they should look at FMCG. We're all talking and looking at improving consumption from the rural markets. IT has gone through a huge amount of downgrades. Perhaps the downgrades are behind us or the pace of downgrades. And number three would be pharma. I think pharma noise levels, or including that on the healthcare performance in India, the noise levels are very high, but I think pretty much very secure. So I would be in these three sectors. Just for a data point, IT and FMCG in Nifty 50 or Nifty 100 have one of the lowest weights ever that we've seen. So I would say positioning wise, looking at history and today, these three sectors should be overweight in a portfolio manager's portfolio in today's times.
Understood. So what do you make of, is the outperformance in large caps largely going to be attributable to the mid and small caps being maybe slightly pricier? Is that what is the possible concern in that pocket?
So if I look at the last 3 or 4 quarters of returns of small cap, mid caps, or compare them to their historical averages, it's the price to earning re-rating which has been driving most of the returns of these indices, not the earnings. In the last 6 months or 9 months, we've again noticed that a lot of earnings growth differential between the mid cap, small cap and the large cap, that divergence is reducing. So if that is reducing, perhaps you will have an earnings led support to the large caps. Earning expectations means no more major downgrade revisions, whereas the multiples which have been driving the returns of mid and the small, they sort of soften or sideways for lack of earnings growth, which is materially different for a cohort as such as compared to the large caps.
So, if I look at your sector selection, that's largely the bottom-up stories, the ones that haven't participated in the market, or at least in the last lap. IT, let's talk about that. Yes. Given that IT was again so restrictive, it was all the AI dominated or the tech themes which did well, not so much the large cap service providers. So while your Persistence and KPIT were relative outperformers as opposed to the Infi TCSs of the world, does that equation change, or is it a blanket now call that you're giving for IT?
Clearly, I would say the mid caps is not what we like right now.
Okay.
So hence many of these mid cap companies, the names that you took, we maybe are sellers on some of them.
Okay.
So we would actually prefer the large caps that way. But there would be still pockets. Let's say a Cyient has gone through a huge amount of stock price correction downwards. PB Fintech, which is another internet story, perhaps, or a TBO Tech kind of names, we would prefer them because these are absolute good quality companies playing out, rather than saying a blanket sell on everything. As I said in the beginning, the cohort I would avoid in the mid cap, but in the large caps, I would prefer, let's say, an Infosys or a TechM, or to some extent even a Cognizant. Those were the names over there in the large cap IT.
Purely because of valuations? Or
Again, yes, valuations, because valuations, and also that reasonable earning support or the risk to the downgrades that one sees from here on could be the least in these, because in the end, market is looking for where the earnings estimates are more stable and the downgrades possibilities are relatively lesser. So hence that could be the structure to that.
Okay, I get that premise, and I get that why the latter makes more sense, that the possibility of downgrades is lesser. But what about the possibility of upgrades at a time when you are still seeing this whole AI transition happen in the world, when you're still seeing so much uncertainty with regards to H-1B visa rules and client spends, and so many of those uncertainties out there. So why services?
So all the AI talk that we've heard of, we haven't yet seen much play out. I've seen this cycle play out 10 years back on robotic process automation. Perhaps it could be different this time. It could play out. I think the H-1B, we know that too many of minutiae that we are not aware of, that we go back and forth. Sure. I'm not saying that the risk is away from the IT services companies. Definitely the risk is there. But in the near term of 6 months to 9 months, how to position portfolios not to lose money, because to making money in the market would be very, very difficult on a market cap cohort basis. If you look at the last CY 9 months, large caps as an index, as a cohort, top 100 stocks, 1.5–2% positive at the best. 1 year it could be even lesser. But if you look at mid caps and small caps, they could be down -3, -4, -5%. And we've seen such periods play out 17 to 20, 10 to 13, 5 to 7, where large caps go sideways, -2, -3% CAGR. So you got to be in stocks where you don't lose much, you have a few winners, but you have very few losers. I would say portfolios should be today made from that point of view for the next 1 year, unless and until, as a portfolio manager, they're looking to add companies which are individual concentrated 15–20 stocks. But if you have wider portfolios, it should be lesser of losers from multiple, which means earnings multiple challenges should be least. I would say that.
Got it. And consumer, right? That's the other theme you spoke about.
Yes.
You're positive with regard to that theme. Is that purely because of GST? Do you believe consumption boost in India will come from all of the policy measures that have come through? And if so, how do you position it? Because FMCG is too wide. So trying to understand what's the best way to play that.
So if you think about in the last year or so, we've been highlighting one point that historically, though the rural wages, etc. in India were holding up on nominal, but in the real inflation was actually not leading much for the growth in the real wages in India. Now for the last 4 months or 5 months, we're seeing real trends in terms of the inflation somehow being softer for the rural folks in India. So hence, rural folks premiumization, which perhaps also trickles down into names like TVS or names like Mahindra & Mahindra, they also fit into that broader consumption basket, they benefit. So I would say more rural and where people have an opportunity to premiumize, where it is less of urban or so. So hence, I would say more companies like Americo, which we've added in our recent portfolio change. Those sort of companies we would add or in the portfolio from the FMCG. So more rural focused because that's where we are seeing a lot more benefits.
So TVS, Mahindra, Marico, broadly.
Those are three big names that I can call out.
Some plays.
Yeah, those are some plays.
Understood. How should one position themselves in pharma? Because you've obviously got some headwind or uncertainty, if I can call it, maybe not headwind, with regard to tariff, which could impact certain companies. And you also have the possible viewpoint coming in that some of these companies in any case are trading at 25 times with the 2029 deadline of patent expiry. That could mean that they ought to, or some of their parent companies are actually trading at single-digit multiples, while the supplier companies sitting out of India are trading at 25 times. How should one try and rationalize that, and how should one play pharma in your opinion?
So when we talk about pharma, we talk about the larger index of pharma and healthcare both put together.
Sure.
Within that, I know that there are risks around the regulator commenting about pricing of the healthcare. I would say hospitals is what we would prefer.
Okay.
We've today changed our portfolio and we've added a company like even HCG, small cap, mid cap, one of the ideas in the portfolio, which is more large cap dependent. I would say hospitals and some companies like even Sun Pharma, though we know that the regulations announced over the weekend perhaps impact Sun, but there's a lot of uncertainty over there. So we would prefer companies like Sun Pharma or a Torrent, those sort of companies in the pharma space, we would prefer them. Very well knowing that there's a lot of noise around the tariffs in the US right now. Well, thematic would say CDMO is the best thing in India. But remember the valuations that you're looking at CDMOs also right now, which actually are too punchy. So hence in a market like this where valuations and growth, you've got to find the right balance where the expectations are balanced with the multiples. And hence I would say pharma companies like Max, companies like, as I said, HCG, companies like Sun Pharma, Torrent, they make more sense to us right now. Even if some of them are punchily priced, their earnings have a less risk of downgrades.
Right.
That's the central thesis.
Got it. Nitin, last question, and I've been told that I need to make this really quick, so I'd request you to do that. But very tough to close a conversation like this without talking financials, right?
Yeah.
And you said that you're playing contrarian. So what's happening there? What's the thesis?
Yeah. Again, I think in the banks, I think last 1 year the returns have been very good. And perhaps what we are seeing right now is you are looking at downgrade risk rising. Look at the last 4 months or so in India. You've seen most of the downgrades happening in the bank sector only. NBFCs are still not looking at most of their input cost of material, which is money, coming down overnight. There are still concerns around the earnings and the wages for people. Remember, just look at what's happening for the last 5 quarters of employee wage growth for NSE 500 languishing at about 6 or 8%, which means that credit runway or credit growth is not crossing to mid-teens, number one. At the same point in time, the credit environment is not turning around, whether it's microfinance or otherwise. And because of that reason, I would say the banks will see 1 to more quarters of earnings downgrades or perhaps reductions. And that's why we are not buyers on that right now. Change our calls a few months back.
Okay, Nitin, on that note, we'll let you go.
Thank you.